Good evening, everyone, and welcome. I am Divya Gopalakrishnan, and on behalf of CareEdge, I welcome you to our discussion today on deciphering data center ecosystem. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Arvind Vashistha, Head Credit Risk Management and Policy, National Bank for Financing Infrastructure and Development. Mr. Deepak Yachmaneni, Executive Director, Everstone Group, and Mr. Ganesh Sankararaman, Chief Financial Officer, Sify Digital Services Limited. This session will be moderated by Maulesh Desai, Director at CareEdge Ratings. We will commence this session with a presentation by Tej Kiran, Assistant Director, and Puja Jalan, Associate Director at CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of any queries, participants are requested to key in their panel. We will take up the queries during our panel discussion session. Now, may I invite Tej Kiran and Puja to make their presentation, please?
Thank you, Divya. Good evening and warm welcome to all participants and esteemed panelists for today's webinar, Deciphering Data Centre Ecosystem. This is Puja Jalan, Associate Director at Care Ratings. Let's begin the webinar by looking at the presentation roadmap for today. In this session, we would glance through the dynamics of India's data center as against global landscape, key drivers acting as catalysts for large-scale capacity addition plans, the growth potential and planned investments, and also decipher some of the challenges in the sector. Thereafter, we shall look at the financial aggregates of the industry players and summarize our presentation with the key takeaways and sector outlook. So let's begin the session with a quick look at dynamics of India's data center industry versus few of the prominent global peers. In the slide, we see comparison of internet users, mobile data consumption, and data center capacity per million users of India with that of China, USA, and European Union. As we can see, the internet user penetration of India is lowest, whereas the mobile data consumption is highest compared to peers. The data center capacity per million internet users in India, in fact, stood at just 1 megawatt as compared to 4 megawatt of China and much lower than that of USA and European Union. There is an interesting data point. India generates about 20% of global data. However, in terms of data center capacity, it has a share of just 3%. Thus, there is a significant underpenetration, leading way for large-scale capacity addition plans. In this context, let us now look at the key drivers for the Indian data center industry. India is transitioning to a developed market economy, and digital transformation is catalyzing economic growth, leading to huge data creation. Some of the key drivers of this rapid digitization are e-commerce, internet payments, online streaming and gaming services, and adoption of new technologies such as 5G, IoT, and artificial intelligence. As we see on the screen, the various multiples exhibited on the left side and the rising trend lines on the right side demonstrate the digitization wave that has swept the country. Apart from this, India offers low-cost benefit for setting up data centers, aided by relatively cheaper land and labor cost. The capex cost, as per a study, for setting up data center in the country is roughly 45% lower versus the world average. In CareEdge ratings experience, we have seen the per megawatt cost in India is close to rupees 40 to 45 crore, which has been, however, on a rising trend. Moving ahead, apart from digitization, let us look at the government initiatives which have been powering the sectoral growth. Some of the measures undertaken by the central government include issuance of Draft Data Center Policy 2020 and according infrastructure status to the sector in the Union Budget 2022-23. The infrastructure status paves way for easier institutional credit, availing long-term financing at competitive rates, and providing refinancing opportunity. In fact, to ensure data security, the regulators have also emphasized on storing data locally which would too contribute to the growth story. In this direction, state governments too have been providing incentives such as stamp duty exemption, power subsidy, rebate on property taxes, and single window clearance. So, based on all these factors, now let us look at the data center evolution, the growth prospects, and the investments which are likely to come up in this space. In this slide, we see the data center evolution growth, which has been divided into three phases: evolving, emerging, and developing. The evolving phase starts with the year 2000, when the first commercial data center was set up in the country. During the first decade of 2000 to 2010, the data center capacity in the country grew at a snail pace, reaching mere 122 megawatt by 2010. That is average addition of just 12 megawatt per year. Thereafter, during the second decade, starting from 2010, referred to as emerging phase as we see on the screen, the capacity witnessed swift addition and grew by leaps and bounds. It grew by 3x till 2020, that is average addition of 32 megawatt per year. So what have been the factors? While the dot-com boom, broadband policy, advent of 2G, 3G contributed to the surge, the major boom came with the launch of Jio as well as UPI payments in the year 2016. The industry witnessed addition of 100 to 150 megawatt per year during the next 3 years, that is 2020 to 2023. So as we can see on the screen, the capacity rose from 565 in 2021 to 722 in 2022 and reaching close to 900 megawatt by 2023. There's not just capacity addition, it has been well complemented by absorption as well. So the utilization levels increased from 82% in 2019 to 93% in 2023. Now what we see is that the industry has entered the growth phase, and CareEdge ratings estimates that capacity is expected to almost double in the next 3 years and reach around 1950 megawatt by 2026. This large-scale capacity addition plans and the requirement has created substantial investment prospect, and CareEdge ratings estimates a capex of 50,000 crore in the space over the next 3 years, that is till 2026. Now, having seen the evolution, the expected growth, and the drivers, we shall now glance through the geographical presence of the data center in the country. As we see here in Exhibit 2, Mumbai is the most evolved data center hub in the country, hosting almost 50% of the existing capacity, followed by Chennai. Apart from Mumbai and Chennai, the other cities with data center presence are Hyderabad, Bangalore, Pune, Delhi NCR, and others. This showcases the concentrated realms of data center. Now, there are some of the prominent reasons behind this concentration, such as availability of supporting infrastructure elements, such as the landing stations, the fiber connectivity, land affordability, etc. Besides, state-level policies are also equally important considerations. So while these cities shall continue to attract bigger capacities, it is pertinent to note that Tier 2 and Tier 3 cities will draw edge data centers which require remote connectivity. So till now, we have seen the glorious growth path of data center, and in our next section, we shall try to decipher some of the key challenges faced by the industry. This section shall be taken up by my colleague, Tej Kiran. Thank you. Over to you, Tej.
Thank you, Pooja. Good evening, everyone. This is Tej Kiran, and I shall take the presentation forward. In the earlier part of presentation, we glanced at the capex cost and project challenges. So let's move to the post-commissioning phase. As we see in Exhibit 3 on the left side, power cost comprises a major cost element, forming almost 65% of the overall operating cost. So the question arises, why do data centers consume so much power? The answer lies in the power usage distribution as depicted in Exhibit 4 on the right side. From the exhibit, we understand that IT equipment and its cooling system consume a major chunk of power, almost 75%. Given the high power intensity, data centers have huge carbon footprint. And in order to reduce the same, DC players need to look at mix of renewable energy and low carbon technologies to ensure cost competitiveness. This thereby brings the concept for green data center, which we shall discuss in our next slide. As seen, data centers have huge power consumption, and in fact, about 1 to 1.3% of power generated globally is consumed by data centers. With the advent of technologies like AI, which requires more computational power, the power consumption by data centers is expected to grow further. In the initial stages, data centers were focused on performance and reliability with lower consideration environmental impact. However, as the capacity grew, green data centers evolved, driven by regulatory pressure and stakeholders' demand for sustainable business practices. Sustainability contribution of a data center can be determined through power usage efficiency, water usage efficiency, and carbon usage efficiency, seen on right side of the presentation. While power usage efficiency of around 1 is an ideal scenario, in Indian context, we see power usage efficiency close to 1.9 for conventional data centers and 1.3 for green data centers due to high temperatures. Thus, we see increased investments in renewable power by data center operators. Based on the poll conducted by Care Ratings, renewable power share in data centers is expected to be over 30% in the next 3 years. Next challenge looming in the industry is the amplifying competition with the entry of new players. At present, data center co-location space is occupied by 4 or 5 major players, the pioneers and early entrants who have a market share of more than 90%. The growth phase of industry has seen new entrants with players from multiple domains expertise such as construction, power, real estate, and as well as investment by global fund and private equity players. This is likely to dilute the market share of existing players to close to 70 to 75% going forward. Huge capex investments needs to be corroborated with streamlining of execution on ground. The new capacities are likely to get observed over next 2 to 3 years, and thereafter the supply may outpace demand. CareEdge Ratings expects an industry consolidation phase after 5 years from now, if the announced supply materializes. We shall now present CareEdge Ratings view on revenue, profitability margin, and expected coverage metrics based on the aggregate of key industry players. As we see on left-hand exhibit, the revenue of industry players has almost grown by 24% CAGR during FY17 to FY23, in line with capacity addition. The revenue growth is expected to continue over the next 3-4 years, with CareEdge Ratings forecasting a CAGR growth of 32% during FY24 to FY26. The EBITDA margin, after witnessing increasing since FY19, mainly due to increasing occupancies, have stabilized at 43% and are expected to remain in similar range over next 2 to 3 years. Exhibit 6 showcases the debt coverage metrics of the industry players, with the interest coverage ratio above 4x during the period FY17 to FY23. Driven by large size investments, the debt to EBITDA has been continuously weakening during the same period. Going forward, with 70% of the capex plans being debt funded, debt coverage indicators are likely to moderate. However, comfort can be derived from long-term revenue visibility backed by contracts with strong counterparties which assure stable cash flows and thus are attracting investor interest. The cash flow stability is an important trait consideration. We shall now summarize the key rating takeaways from our today's presentation. CareEdge Rating expects investments of 50,000 crore during FY24 to FY26 in building up data center capacity. Sustainability challenges would also lead to the investments in renewable power by data center players. Capacities are likely to double from 0.09 gigawatts in FY23 to 1.95 gigawatt by FY26. And aided by capacity augmentation, the revenue is expected to grow at a CAGR of 32% during FY24 to FY26. CareEdge Ratings expect the EBITDA margin to be stable over the next 3 years, around 40%. However, there is likely moderation in debt coverage metrics with incremental debt financing. In the long run, that is in about 5 to 6 years, if the planned capex goes live, the demand-supply gap is expected to narrow and result in increased vacancies. This will likely to suppress margin profile and lead to industry consolidation. To summarize, the sector is poised for strong growth and at maintaining harmonious balance of profitability and leverage shall be a key for sustainable growth. Thank you. With this, we come to the end of the presentation, and I shall now request Divya to take it forward.
Thank you, Tej Kiran and Puja. As mentioned earlier, attendees are requested to key in their questions, which we will take up during our panel discussion. Now, may I invite Mr. Maulesh Desai to take over the session, please. Mr. Maulesh Desai is Director and Rating Head with CareEdge Ratings for the transportation sector and handling the portfolio of infrastructure sector companies. He holds a bachelor's degree in engineering, MBA finance, and CWA. He's also an associate member of ICWAI and certified associate of Indian Institute of Bankers. He has more than 18 years of industry experience, including 15.5 years with CareEdge ratings. Prior to joining CareEdge, he worked in credit appraisal and credit operations in a large private sector bank. Over to you, Maulesh, sir.
Thank you, Divya, for quick introduction. Many thanks to Pooja and Tej for wonderful tech presentation. Good evening and very warm welcome to one and all participants. As we all know, data is precious and will last longer than system. Indeed, that's the significance of data and so also for data center. It is our pleasure to have experts today to decipher data center ecosystem and share their deep insights with us. I would now like to introduce each one of them in alphabetical order. First one is Mr. Arvind Vashistha. Arvind is part of the leadership and startup team at National Bank for Financing Infrastructure and Development, NABFID, and heads their credit risk management and policy function. At NABFID, Arvind oversees the entire credit risk management framework, credit policy, and monitoring. Arvind has more than 2 decades of leadership experience in infrastructure and corporate financing, credit underwriting, and equity investments across banks, financial institutes, and corporates. Prior to NABFID, he was the corporate credit head, wholesale banking, and part of senior leadership team at IDFC First Bank. Arvind is technocrat and also holds an MBA Finance from Sydenham University. Welcome, Mr. Arvind.
Thank you,
Next
Maulesh.
panelist is Mr. Deepak Yachmaneni. Mr. Deepak is an executive director at Everstone Capital's digital infrastructure business. He leads the asset management function and oversees hyperscale client coverage, business strategy, and capital raise. He has over 2 decades of experience and has been closely involved in the growth of data center ecosystem in India. Prior to join Everyonder, Deepak set up the India business for Breeze Data Center. He brings cross-functional experience in real estate and financial services with proven capabilities in conceptualizing and building successful businesses. Deepak has also worked in management roles at Avendus Capital, Barclays, and Kotak. Deepak is technocrat and also holds MBA from IIM Lucknow. Very warm welcome, Mr. Deepak. Our third panelist for today's session is Mr. Ganesh Sankararaman. Mr. Ganesh is Senior Vice President of Sify Technologies Limited and CFO of Sify Digital Services Limited. He also holds directorship position in various Sify Group companies. In his earlier stint, he was CFO of Perry Sugars Refinery India Private Limited. Mr. Ganesh has also been involved in various business and finance forum as a guest speaker. He has also secured various awards for his leadership role in the field of finance. He brings rich experience of over 24 years while handling gamut of responsibilities in the field of corporate finance, M&A, and risk management. He is qualified chartered accountant as well as cost management accountant. Welcome, Mr. Ganesh, in today's session.
Thank you.
It's time to quickly set the context before we begin the discussion. We are in dynamic phase with respect to data centers scaling new highs in India, lending large opportunities. Under penetration of data center capacities in India, rising adoption of new technologies, cost competitiveness enjoyed by India, and conducive regular environment augur well for the sector. Yet, sector potential is also exposed to scaling up challenges, be it technological, operational, project-specific, or financial front. In order to get more interesting view, let me now turn on to our esteemed panelists who have joined us to share their deep insights. So my first question is to Mr. Ganesh. Undoubtedly, we are in interesting time with respect to investment in data center of around rupees 50,000 crore from FY24 to FY26, as seen in the presentation. Over and above this, there are large announcements made by some of the players, which can exceed the capacity addition potential beyond 2 gigawatt also. In this context, what all are the challenges in the sector which can restrict the growth potential, Mr. Ganesh?
Yeah, good afternoon all, and
I warmly welcome other panel members as well. And it was a good presentation by CARE. See, it is very evident that India is going to be a data center hub for APAC for a period of time. And
Mr. Ganesh, can you speak louder?
Hello?
Yeah, can you speak louder slightly?
Further louder.
Yes.
Is it fine now?
Yeah, it's fine now.
Yeah. So India is going to be a data center hub in a 5-year period of time, and very evident that India is going to have many capacity additions going to be seen in next few years of time. You've given that 50,000 crore of investment to be made for the next 3-4 years. I think it is going to be furthermore on the north side, because data center cannot run on its own. It requires network and it requires renewable energy aided investments as well. If you put those things, it will be about 55,000 to 60,000 crores of investment is going to be there across the functions. And now it is going to be the data center run for the next 5-6 years, because now the requirement of data center is yet to be filled by the existing players. It is not possible by the existing players to meet the demand which is already been there in the market. So it is furthermore evident that new players has to come, and it is we welcome, in fact, in the data center market, we welcome the new players to come so that the existing demand can be met. And I don't see any further issues in terms of the possible issues in terms of having the new players. Having said that, India is going to have 5 trillion economy in 2027, and 1 trillion economy will be from the technology part. I think a data center is going to be there as one of the major player in 5 trillion economy front, because we are all talking about digital economy, digital India. Digital India can be made by two major players. One, the network player. Second one, data center player. Network player, where the data is getting transmitted from one location to another location, and data has to be stored in a place where data center is located. So in the next 5-6 years is going to be data center era. I think there is no issues in terms of bringing or having new players in the market. I don't find any issues in having that, because existing demand cannot be met by the existing players.
Thank you, Mr. Ganesh, for bringing very important perspective of requirement of a new player, in fact, in the sector for bridging this demand-supply gap. And in fact, in our presentation also, we have seen that the players with a varied domain experience, they have forayed into this space. So in this regard, my connecting question is to Mr. Deepak. What expertise the new entrants are likely to bring to the table? That is one. And second, what are the challenges that the new entrants are facing in the sector?
Thanks for the question, Maulesh. So two things, I think when it comes to the evolution of any sector, I think there is both a mix of capital and technology that's required for growth of any industry. And when you see the Western world, which I think bore out in the presentation that we saw a little while back, there is definitely a learning curve that data centers in India are undergoing as we speak. And when it comes to global practices, whether it's in terms of green data centers or technological advancements that are happening to bring in and process AI workloads, or even the legacy cloud businesses, etc., I think there's a catch-up that's happening. But still, I think most of these technologies have originated in Western markets, and that's something that the new players are bringing in, while existing players are also well equipped, and it's a learning curve for the entire segment. The second one is capital. I saw your slide, and it's quite evident that there's a lot of capital requirements that are envisaged over the next few years, and that's something that global players have been able to commit in good measure to the Indian markets. The
Well
second
said,
part of the
Mr.
question, if you can.
That's on a challenge side. What are the challenges the new entrants face?
So I think not just for new entrants, I think it's also for existing players. I think in India, the some of the most important ingredients for expansion are power and connectivity. Typically, infrastructure on both these counts have been available only in metro cities. So when we talk of tier 2, tier 3 cities or markets, while again, if we look at more evolved markets like US, you can go outside of your top few cities and still have very robust connectivity and power available to you. Whereas in India, it's still the same traditional, top 4-5 cities, which are driving most of the data center demand. So land with power and infrastructure available right from the edge of the location of the plot that you're building becomes a key bottleneck in expanding and scaling rapidly. So if I were to summarize what can come in the way of expansion, capital ceases to be a constraint given the kind of interest and the growth that the market has. And it's more the availability of land with very specialized infrastructure that these data centers require.
So well said, Mr. Deepak. So you have brought the two important points, technology and capital. So that is in these two domains, people are bringing the expertise. And the challenge front, you mentioned that the power and connectivity in the non-metro city. So that requires to be improved in order to attract those 50,000-60,000 crore investment in India. So my next question is to Mr. Arvind on this. Like in the presentation also, we have mentioned 50,000 crore investment opportunity. And Mr. Ganesh has also mentioned that including network and necessary, this investment can go up to 60,000 crore. So, and in our study and our experience, the CARE rating has observed the per megawatt cost for data center is coming to around 40 to 45 crore, excluding the land cost. So, what is your experience in terms of cost of project per megawatt for the as a lender? And as a lender, how do you evaluate the project viability for the data center?
Sure. Thank you, Maulesh, for inviting me to this panel. Good afternoon, everybody. Good afternoon to my fellow colleagues here. Indeed, a very exciting presentation which CARE made. To answer your question, Maulesh, let me start with how do we really go about the project viability, and that could actually cover also part of the question with respect to what's the kind of cost per megawatt, if I were to say so, which is what we have been observing. So I think from a lender's perspective, the credit risk for such projects is very much similar to what we would see in commercial real estate projects. I would not essentially say that they're equivalent to commercial real estate. There are obviously differences around it, but there are obviously some considerations which would go in here. So typically, the lenders would look at starting from the sector. In this case, Ganesh obviously made that point that there's a very exciting road ahead, very positive, strong demand drivers here. Push from the government, we are seeing at least 7 to 8 states who have well-defined policies around it. We are actually seeing a push from the government. It has been included in infrastructure definition since I think December 22. So all the right pieces there from a sector perspective, so pretty positive on that. Before we move ahead, I mean, there are two broad tenets here in which the financing landscape can be approached. One could be a pure construction financing, and one is more like a rental discounting, which can happen post the operation phase. In either of these, I think one of the key considerations that lenders typically would tend to look at is the sponsor profile. And here, apart from the basic ingredients which a sponsor profile would have, some of the other key things that they would look at is on their ability to bring in the tenants at a later date and how sticky they could be. The location micro market assessment also is a key thing to look at. We have been actually experiencing, and not just at NABFID, I think otherwise also, very, very unique structures as well, wherein the project implementation assessment becomes very critical. We are seeing that whilst the demand drivers are pretty positive, there is also this whole thought that the development can actually happen over 2 to 3 phases, in wherein the developers commit the capital for one phase and really will wait for the settlement or the first phase to be settled before they can actually commit capital to the second phase. This is something that lenders tend to kind of view with caution, and depending on the sponsors and the profile of the borrower, this is kind of seen very closely. The treatment of revenues which comes from the interim phases before the real COD happens for the project is also something that gets a consideration here. I think absorption assessment is very clear, very similar to what we would see in commercial real estate projects, where the renewals of the lease or renewals of the rentals here are actually much before the expiry of the debt. So I think the resultant tenors which we have been observing here, in spite of this being an infrastructure, is typically in the range of 8 to 10 years. The last but not the least is the transaction structuring piece, wherein at least we are seeing that lenders would want a kind of the sponsors to stay in with some kind of a management covenant and shareholding covenant, so that the operational control over the asset can be maintained. Overrun funding is something whilst haven't been seen in quite a few projects that we have seen, but yes, that's also an important consideration for lenders as to how that gets funded. Type of pre-leases. These are some of the mitigation covenants which actually come in when lenders are assessing here. So all in all, quite a few similarities with the commercial real estate credit risk assessment. To answer your second question with respect to the project cost, I think depending on the project configuration, and that Ganesh is here and Deepak, and they can throw light. But depending on the project configurations, we are seeing actually the cost to vary in a band which starts from something like 40-45 crores right up to 70-75 crores. And this would be a mix of variety of the combinations. This could be the co-location, this could be the managed services, this could be even the distinction between tier 3 and tier 4 kind of data centers. So we have observed these kind of bands, but obviously no benchmark in that strict sense, because I think what we are increasingly trying to understand is that a lot of it depends upon the client's requirement in a co-location services, and hence the cost can vary on that account. So that's really the experience on this front.
So very simply put, the broad points that you highlighted is the cost is dependent upon the client location and co-location and the type of city that they are. And in terms of your methodology, while funding, you will do a counterparty assessment, absorption rate, and the parameters that are generally used for the real estate, operational real estate lease entity, apart from the sponsor profile. So these also does echo with the care ratings methodology on the rating of the sector. So that's quite reassuring. So moving to our next topic on sustainability of the data center, that also we have discussed in the presentation. So in the presentation, we have emphasized on a sustainability through investment in a renewable energy and advanced cooling technology to meet ever increasing the power density per rack. In this context, my question is to Mr. Deepak. What is the size of investment industry is looking for procuring power through renewable sources? And according to you, how much percentage of power requirement for data center shall be met through renewable energy?
Interesting question. So I think more than the willingness of the data center developers to bring in renewable energy, or the client wanting to bring renewable energy because they are fully committed, the end use customers as well as data center developers would like as much renewable power as possible, because India is one of those rare countries where renewable power is abundantly available and is cheaper than grid power in most of the states that are of relevance.
Yes.
This is completely different when you look at other Asian countries also, where you have to pay a premium to get your green energy. However, having said that, the biggest challenge is distribution, right? While generation of renewable power is very, very high, the last mile connectivity, which is what I alluded to when I said availability of quality infrastructure, distribution is still a state subject, and every state that you go to has very different rules on how much renewable power is allowed in that particular jurisdiction. So this limits what actually can be used for renewable power. It's not the choice of the developer or the end user, but more regulations that govern the peak utilization of renewable power.
Okay. So you have mentioned that it is more dependent upon the distribution entity, and the limited choice is available to the developer. So understood that point. So the second point is with respect to the cooling, because with the emergence of AI and graphical processing units, the cooling requirement is also expected to increase. So my the next question is to Mr. Ganesh on this. So what's your take on adoption of a newer cooling technology, and what will be the additional investment expected because of those different cooling technologies?
Actually, if you look at whether it is for the climatic change or for the purpose of reduction in cost, I think everybody has to necessarily go for green building and renewable energy source for all the processes. One, it is cheaper, as Mr. Deepak has mentioned. Distribution is still a state subject, and some of the states are very magnanimous in actually accepting power from other location and giving subsidy on the power cess and all. I think some of the states has to necessarily go for accepting those facts that power is an important element for this kind of industries. Here, even green energy and usage of fossil as oil, where it is whenever there is a possibility of reducing the cost and reducing the energy, I think you can beat the competitiveness in full swing. For example, if you have enough gap in terms of two walls and having lesser fossil oil, and have green energy fully, and have renewable energy source for all the processes, I think you will be in a position to meet the cost element. Whether the customer is asking for renewable energy, I think the company has to go for renewable energy for reducing the cost in full aspects. It is not forced by anyone. I think for the cost benefit, one has to necessarily go for it. What is the second question you have mentioned?
What will be the investment requirement for the newer cooler technologies?
Would be at I think it depends upon the power you are going to use it. It would be about 10 to 15% of your cost is going to be used for renewable energy itself.
Okay, understood. So before we begin our discussion on the next topic on the competitive intensity, so I would like to ask one question to Mr. Arvind. So this is on an edge data center. So as a lender, how is your experience in funding of the edge data center?
So, Maulesh, honestly put, we haven't seen quite a few edge data centers at this point of time, since we are also in the nascent stages of operations. But what we hear from the market is that there's a lot of excitement around it, given that ultimately it is relying on a very positive demand driver of the retail consumption story to really take it forward. But I think beyond that, as an institution, not really much experience on that at this point of time.
Okay, understood. So moving to the next section on competitive intensity, as we have seen in the presentation, that the competitive intensity has increased and it is expected to increase further in the future. So that may also lead to consolidation in the industry. So in this respect, my question coming to you, Mr. Ganesh, on this. So hyperscalers like Amazon, Google, and Microsoft, they are setting up their own data centers in India. So due to this, do you foresee that their own capex will have an impact on a co-location operators, as these are the major clients across the data centers?
I think it is not the case because the demand is so high. They can't wait for other data center to construct and be ready. Since the demand is very high, I think they are actually putting their data centers so that a portion of demand can be met by own consumption, because they are constructing for not for sale, for consumption of their own. So the existing players or even new players need not worry about those things. And as I mentioned before, the cost is the one of the element one has to consider, because they are also aware that what is the cost per data center megawatt. So in order to compete with the existing data center and the data center is going to be constructed by hyperscalers, I think cost and quality would be a major factor. So those data centers for self-consumption, because the demand is very high.
Yeah, so just to summarize, you are saying that because demand is very high, so because of that, even if the hyperscalers they set up, because they will set up for their own captive purpose, so it is not expected to impact the players having a cost competency.
Yeah, in fact, in the first round, I was said that existing players cannot meet the demand which is being already been raised. So the new players are already on the way, and by 2026 and 27, I think most of the players would be ready with their capacity, and the real competitiveness can be seen after 2-3 years, once everybody having their data center ready for operations. Then the real benefit of cost and skill set or operational capabilities can be seen in the market. Now it is like a demand which is actually pushing existing players to go for new existing hyperscalers going for new data center players. I think next few years, maybe 3-4 years after making all these investments you have mentioned, that the real the data center players and having the skill set, having the expertise, having the capabilities will emerge in the market.
Understood. Mr. Deepak, what's your take on this? That with increasing competition and adding capacity, do you estimate any moderation in profitability or occupancy rate in the future?
I think I have a couple of points to add here. One is, if I again look back at global examples where it's much easier to secure land and build. So typically, just to give a little context, a typical data center in India requires a minimum of 36 to 48 months to complete, right? As against some evolved economies where you can technically get a data center live in 13 to 15 months, right? So that's one critical aspect that one needs to consider. So the kind of announcements, the kind of capital that is waiting to be deployed will take time to find its way into the markets. It's not going to materially come on stream at the same time. So in that sense, I have more moderate expectations on what could actually be done within the next 2 to 3 years. That's point number one. Point number two, again, referring to the question you mentioned, even in Western world, you are looking at a mix of self-built or self-owned versus third-party providers for the hyperscale names that you mentioned. So it's not a lack of choice. It is a strategy where there will be enough growth and enough demand from these very clients to ensure that there's adequate offtake for each of the new capacities being announced. Second, it's too early to comment, but the kind of tectonic shifts that AI is bringing on and the demand for data centers, because at the end of the day, the raw material for each of these AI experiments is data centers. We've seen only the US see a bulk of the deployments for AI use case. And what that capacity is is today very, very opaque. And if we were to just look at some of the larger companies that are listed in this space who offer cloud services, their acceleration of capacity uptake just for getting their AI models in place, the generative part and the training modules to bring it to market has been in hundreds of megawatts in the US market.
Yeah.
Right. Just one market, it's a few months old, but hundreds of megawatts have just been taken for that end use.
Yeah.
So my reading of the market is that this demand is yet to even percolate down to India. We are not even hearing of anything at this point in time, but it is bound to happen given a market of such size and such importance to the American tech firms. This will surely find its way. How many years will it be? What would be the capacities? Too early to predict. But I can confidently say whatever is the capacity that's on the mat right now will be short of whatever the demand that is to come.
Quite promising, Mr. Deepak. And you have also highlighted that the longer construction period that would also mitigate this competition-related risk apart from the emergence of AI, wherein the demand would actually short of the supply. So, well articulated. Yeah, Mr. Ganesh, would you like
I would
to
like
add?
to add one point that new players has to necessarily wait for those time, 48 months, maybe late, maybe furthermore period as well, because they have to necessarily prove that they have to necessarily demonstrate that they are capable of doing their managed services as well. Because not only co-location, if they have combination of co-location and managed services, they will be in the market for long. So the new players would take furthermore time to demonstrate and get the customer acceptance. I think that will take furthermore time for the new players. I think they should have the patience to get things done, because this is not something which can be done within short span of time. And the customer engagement also would be for 5 years, 7 years period. And if you add 5 plus another 7, they have to be necessarily be in the business for next 12 years. So this is a long-term play. So to the extent the new players has to understand that it takes time for them to participate and be in the market.
Same similar reply. So, for next question, I would like to ask to Mr. Arvind. So, since both Mr. Deepak and Mr. Ganesh, they have mentioned about the positive demand outlook, and there will be a lot of capacity also will be coming up. So, from a lender perspective, so while funding those projects, so what are the broad covenants that you mentioned to mitigate some of the risk that you foresee?
Sure. I think I would concur with what Ganesh just said, that you're really looking at players with a long-term view, and I think that's the philosophy most of the lenders also look at. So to start with, when we're looking at such opportunities, we really look at who's really backing the development and how long-term is their outlook. I mean, even at NABFID, we are essentially a long-term lender, but otherwise also, I think that's a key requirement to be looked at. And for that, essentially, you will have typical covenants on the management control and shareholding. These need not be financial support, but obviously, it is an operational support that may get extended from the entity which is supporting the platform or the SPV, as the case may be. Typically, again, from execution perspective, there may be challenges which may happen on the cost overrun. So there are covenants around who funds the overrun, in what capacity, etc. Obviously, as I said, we are seeing several models of development. One of them is a phase-wise development, in which case, what happens if the phase 2 doesn't take off for reasons other than demand. So I think the demand story is very strong. No one denies it, but for whatever reason, if the phase 2 or phase 3 or whatever that phase is, if it doesn't take over, then we would typically assess that excluding that development, does the project still stack up from a cash flow perspective, and does it really need any support from the entity which is developing it? The type of lease is another criteria which is there, which would kick in depending on the track record of the sponsor. So, for very strong sponsors, well, this may be pretty low to begin with, but for new entrants and who have still to demonstrate their long-term commitment or presence, this could be relatively higher. The typical financial governance, needless to say, would be there. One increasing trend which we're seeing is that since the construction finance is getting replaced by the LRD finance at the operation stage, so one view is that, which is also emerging amongst lenders, is that are you really funding a long-term facility at the time of construction? That also is a key criteria. Last but not the least is at the time of renewal, do you really foresee any risk? Again, from a demand perspective, while that doesn't seem to be an issue, but for any other reason which can actually derail that, do you need to put any covenant around it? So this is very broadly that lenders do see such kind of projects.
Thank you, Mr. Arvind, for bringing lenders' perspective and the risk mitigation mechanism to safeguard some of the risk. So we will be taking the questions from audience shortly, and participants are requested to key in the questions. Before we take the questions from the audience, so my last question, either Mr. Ganesh or Mr. Deepak or both can answer. So that is with respect to the edge data center. So while the telecom entities are primarily looking to expand at this space, would it be economically viable for the co-location player to look at the edge space, particularly in the tier 2 and tier 3 cities? So that is first question. And second, apart, since the majority investment is concentrated to few states, and now states are also coming with the various benefits and incentive to attract the investors. So what are the other states do you foresee that the policies are favorable? So these two questions.
Okay.
Mr. Ganesh, if you can answer.
And two questions are interconnected actually.
Yeah.
One, see, we know that data center is a place where data is getting stored. This is a warehouse of data. Since Mumbai is a place where data is getting generated and getting consumed, I think that is the reason the most of the data centers are located in Mumbai. So it's quite obvious. So we'll not be losing time. We'll not be losing cost. Cost efficient would be there. So it is very evident that we have to be necessarily at Mumbai for meeting the Mumbai requirement. And of course, Delhi and Chennai because of cable landing station and the connectivity in the east side. So quite obvious that Mumbai and Chennai is going to be the future data center hub for India. Second point is that the edge data centers, I think edge data center is a small form of data center. It is evident that it is going to be there in small cities and towns where the bigger data centers are not required to be maintained. So I would say that other than these 3 or 4 locations like Mumbai, Delhi, Hyderabad, Chennai, I think Bangalore, Pune, those states and cities where you'll be getting edge data center in a big way. And next level towns are all will be having edge data center where data consumption is going to be high in the coming years of time. In future, we are going to see more of edge data centers that is connected with the main data centers as well.
So Deepak, would you like to add?
Yeah, just some of the applications that require low latencies. What's happening today in India is a lot of the big locations are serving the needs of most of the data requirements of the larger populace. But what will change this is low latency operations like applications like, let's say, automated driving, or if you look at applications which are more live, right? So that's when the compute or the processing has to move closer to the markets that you're trying to serve. 5G rollout remains one of the key deliverables or something on the watch list, because unless the speeds, you see in Bombay itself in a metro, you have your 5G, 4G popping on your screens, but really the speeds don't do justice to the kind of capability that the system should provide. So that's something that we will watch out for, because that will lead to demand for, let's say, whether it's streaming, whether it's self-driving, whether it's Internet of Things, requiring more localized compute. As and when those applications or use cases evolve, is when data centers will have to move from the hubs to the smaller towns, cities, tier 2, tier 3, and other cities. And that's something that will happen with these infrastructural developments on the telco and the connectivity side.
Yeah, well articulated, Mr. Deepak and Mr. Ganesh. Now we will begin with the audience question. So my first question is to either Mr. Deepak or Ganesh can answer. That is on a renewable capacity. So the question is that what will be the renewable and non-renewable mix going forward, given the high power requirement in the industry and carbon footprint is also very high. So this question is from Mr. Dinesh Balaji. Mr. Ganesh, if you can answer.
As Mr. Deepak has already mentioned that it is a state subject. Each state has put the limit up to which the renewable energy can be connected with that grid. So beyond which I cannot have 100% of the grid connectivity to my data center, because there is a limit up to which I can connect. So every state has its own percentage of connectivity in the renewable energy. And it takes time for the company or any data center to get connected with the renewable energy, because that also, the renewable energy process also takes about 2 years of time. So max we can have about 65 to 75% of renewable energy connected with the data center. I think if the data center requirement, the energy requirement goes up, then you can connect furthermore. The energy consumption and the renewable energy source should be moderated in such a way that you will not be having excess energy, you will not be having shortage of energy as well. So investment in renewable energy and your data center energy consumption should go in tandem, so that you'll be having a mix of both for the benefit of entire cost competitiveness. So there is no specific rule for a particular state, because each state has its own acceptance or percentage of renewable energy to be connected with.
Okay. So next question is from Sanket. So this question is on the financing. So Mr. Arvind can touch base upon it. So the question is about the financing of data center and allied activity. Is there any data points around the foreign versus domestic investments at present? And second, in the future, is there any possibility that the data center company or investor wants to launch an InvIT and to finance the new data center?
I think let me take the second question first. The first question will have several data points around it, but let me take the second question first. So we keep on hearing this interest from developers, and we have the presence of esteemed panelists here as well, that eventually data centers may roll out into an InvIT. I think from the lender's side, the whole genesis of an InvIT is that underlying the InvIT there are stabilized assets or assets with stabilized revenue profile. So in that sense, definitely data centers would fit into the InvIT structure going forward. And the good part about the InvIT structure is that it's a regulated entity, so there are several checks and balances built in around here. So from a lender's perspective, if you look at it, we would rely on two to three important considerations here. One is it's a regulated entity with clear guidances on leverage, which is a key consideration for lenders. Number two, the corporate governance itself is of top notch. So interestingly, the players in the Indian data center industry obviously come with a very rich governance around the structures. But that gets further enhanced when you go to an InvIT because of the several disclosure norms around it, and the foreign entities participating in it, which have their own standards of governance. So all of this definitely augurs well if it were to move into an InvIT structure. I think that's how lenders would look at it. So it's definitely a positive from a financing perspective. Yeah.
Next question is from Mr. Anil Kamath. So, Mr. Deepak, if you can answer. So, what is the ROCE for a data center investment in a stable state? That is his first question. And his second question is on the connectivity. That what will be the investment in the connectivity to match the data center investment of 50,000 crores? So, partly it was answered earlier also in the panel discussion, but if you can elaborate further.
Right. So I hope I can give you a straight answer, but I cannot when it comes to ROCE, because as Ganesh also referred to, there are different business models within data centers, right from hyperscale campuses which only cater to very large single customers like Amazon or Microsoft or Google. So they are purpose-built custom infrastructure projects, to co-location, which is one level down, which caters to enterprise segment, to one level down where you provide managed services or a combination of cloud and managed services. So the business models are distinct. There's no one ROCE bracket for data centers as a whole. So ROCEs broadly would range between mid-teens to mid-20s for all three business models put together, but each of them will have its own nuances. That's point number one. Connectivity for deployment of 50,000 crores, that's again an interesting conversation. There is adequate power. It just needs to find its way into the locations that are being sought by end users. And that will happen as the existing locations become more saturated and land parcels dry up in these locations because there's only finite land. We will have them move gradually outside those zones, and new zones will be created. And there would be enough appetite or enough land available because governments, as you mentioned, are also taking a very, very keen interest in beefing up the distribution infrastructure. So in that sense, I do not see a challenge in the deployment of the pipeline that you discussed.
Okay. Mr. Ganesh, if you want to add anything.
In fact, those who are having connectivity, data center and cloud will be having advantage over others because of the cost and customer engagement per se. As you said, now relating to ROC and all, as we have a mix of hyperscalers, enterprises, and a mix of co-location, managed services. So one is capable of doing all three products, will be having added advantage over others in terms of meeting the customers. That is the point. The new players is coming into the market find it difficult to get the customer base because the customer wanted to have one solution for all the three issues. So the engagement we have with the customer in the initial point in time would be very difficult for the new players to get into the confidence so that their ROC would be better in the next period of time. And once Mr. Arvind also mentioned that the cost of construction of data center, the new players are on the higher side as compared to the existing players. So to the extent they'll be having competitive disadvantage over others. So they have to have the cost on check, both on the capital cost and also the operational cost, so that they'll still be there. They'll still be in the market. They'll be having enough megawatt of power of capacity to serve the customer, whether it is manageable or whether they'll be in a position to make it in a most profitable venture is a question before them. Because if the cost is up, and I think that cannot be recoverable from the customers, because now the customer has majority of major players in the market. Instead of 5, they have 20 now. So they can also reduce the cost. So one has to be very clear about what is the cost of investment so that they will still be there in the market in the long term.
Yeah, so you mentioned about the cost competency. So actually the next question, that is the connecting question, is on the cost itself from Ms. Swati Chelani. So the inconsistency is observed in the per megawatt cost for across different data centers. So what all could be the parameter? What is the reason for the deviation in the cost per megawatt across various data center, according to you? And what should be the any benchmark cost per megawatt, according to?
That is also is a relative question. Cost, I cannot fix one number. See, where the data center can be constructed. The data center can be constructed where the data consumption is very high and the requirement of data storage is high. The data center requires land, the data center requires network connectivity, the data center requires electricity upscale. If the existing land available for meeting all these three, then the cost would be less. If I'm going for something, the land cost itself is now 3x. After that, I'm having network connectivity, that is also going to be high. And in addition to that, if I don't have enough infrastructure with respect to electricity, then cost will automatically will go up. Choosing the right place where data center is located is also very important aspect to to have the data center. It is not like Mumbai, I cannot have everywhere data center. I need to have a particular place where the land is available at a competitive price, and there is an element of electricity supply is there, and there is an element of network connectivity is there, because all the three are ingredients to have the data center. If somebody is choosing wrong, if any one goes wrong, I think the cost will go up. So that is the reason people are having 40 to 50, 50 to 60 crore per megawatt.
Well explained, Mr. Ganesh. So because of the paucity of the time, we will take a last question from the audience, and that is from Mr. Yash Gandhi. So is there any differentiation amongst peer in the industry? That is his one question. And second, what makes a one player better or efficient than the other? So Mr. Deepak, if you can answer.
Sorry, I didn't understand. I mean, follow the first
question. What is the differentiation among the peers across the industry, within the industry? That is the question.
Right.
And what parameters makes one player better or more efficient than the other?
Right. I'll touch upon a few things. Again, we come from a world of hyperscale data centers, so that's the segment I understand best, and I can provide some insights there. So while cost is an important aspect of building a data center, the clientele that we deal with are extremely demanding, because unlike other real estate related asset classes, where cost is possibly a very important dimension for the delivery of that particular service, whether it's an office or a warehouse, we have to look at digital infrastructure in a completely different light. Cost ceases to be beyond a certain point. It's just a filter. It is not the key for decision making, right? The quality that is required and the operations, because for any cloud offering, the margins that some of our competitors have are unparalleled to any other asset class, right? So the real estate or the data center cost for an end user is minuscule, right? Whether it is $95 or $100 doesn't make any difference to them, right? So the parameters that are of absolute importance to hyperscalers is your design, whether you have the flexibility to make it more future-proof. Because what's happening with legacy data centers is, as we speak today for AI workloads, even DCs built 2 years back are obsolete in terms of the technology that can come for new workloads, right? What legacy workloads are going on is perfectly fine, but for new workloads, they are not suitable. It's already obsolete. So to address that point, and secondly, when I look at more evolved economies, there is something like a menu card. So today there is no, and that addresses some of the questions that you asked earlier, is today a customer comes to us with their requirements, right? Not all data centers are equal. Not all workloads that a hyperscale client wants are equal. Some of them could be a secondary data center and you may outfit it in a completely different specification. And you may have your architecture in a way where one of it is a primary architecture where you want to go all out in terms of the specification. So that explains the variance of why the costs are in some cases low and in some cases high. Given the capacity, see, when I started out in the industry, a 4 or 5 megawatt was considered absolutely the peak for any one contract. So when in my previous stint, we did a single contract of 20 megawatts, which was unheard of until that time, right? Now the 20 has moved to 40, 50, and it's counting and it's growing up. When you commit to that kind of capacities, you are not happy going with legacy behavior where I don't have adequate supply and I have to sign up with whatever is available, right? So today you are saying build custom build premises for me, do an entire campus with my specification. And most of these discussions are yield driven. They are not cost driven. Right. So I, as a developer, do not care what my cost is in some case, as by all means, I have to be cost competitive. But the ingredients of what I put in a data center is absolutely governed by what my hyperscale client wants. I cannot have this luxury when I'm doing enterprise or managed services or co-location services because I have to cater to a wider audience. But when I'm talking to hyperscale as a segment, costs don't come into play as much as the other segments.
I think we have had a very interesting session today. And more importantly, we have gotten a clear answer from our esteemed panelist. And we all agree that Indian data centers are set to scale a new heights in terms of capacity additions with an emphasis on sustainability. So thank you once again, Mr. Arvind, Mr. Deepak, and Mr. Ganesh for your deep insight and patiently answering all the queries of participants that were posed within this time constraint. I am privileged to host you all in today's session. Thank you all participants for joining us today in hectic March end schedule, and wish you all very happy Holi also in advance. Thank you. Thank you very much. And I am handing over session to Divya for the closing remarks.
Thank you so much, Maulesh sir, for moderating the session, and Tej Kiran and Puja for your presentation. Once again, thanking all our guest speakers for their insightful views. It was indeed a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestion, please write to us in the feedback email. Goodbye for now, and I request the tech team to kindly log off.